Imagine having a safety net that can cover your living expenses for 3 to 6 months, giving you peace of mind and financial stability. But how do you build such a fund from scratch, especially when you're living paycheck to paycheck? It all starts with understanding the importance of having an emergency fund. This fund is not meant for saving for a car or a down payment on a house, but for unexpected expenses like medical bills or car repairs. For example, if your car's transmission fails, you could be looking at a $2,000 to $3,000 repair bill. But here's the catch: how do you save for such expenses when you're barely making ends meet? The first step is to assess your current financial situation and create a budget that accounts for all your income and expenses. Let's say you make $4,000 per month and your necessary expenses like rent, utilities, and groceries add up to $3,000. You then have $1,000 left for discretionary spending and saving. But how do you allocate this $1,000 towards building your emergency fund? A good rule of thumb is to allocate at least 10% to 20% of your income towards saving and debt repayment. Using the previous example, that would be $400 to $800 per month. However, if you're starting from scratch, you might want to start with a smaller amount, like $100 or $200, and gradually increase it over time. But here's the thing: what if you have high-interest debt that you need to pay off? When you have high-interest debt, it's essential to prioritize debt repayment while still building your emergency fund. Let's say you have a credit card with a $2,000 balance and an 18% interest rate. You could consider consolidating your debt to a lower-interest loan or balance transfer credit card. For instance, if you can get a 6% interest rate, you'll save $120 per month in interest payments. But what about the argument that you should focus on saving first? Some experts argue that you should focus on saving $1,000 as quickly as possible, even if it means putting debt repayment on the back burner. The idea is that having a small cushion can help you avoid going further into debt when unexpected expenses arise. However, this approach might not be suitable for everyone, especially those with extremely high-interest debt. But what about the role of automation in building your emergency fund? Setting up automatic transfers from your checking account to your savings or money market account can make saving easier and less prone to being neglected. For example, you can set up a monthly transfer of $200 on the day after you get paid. This way, you'll ensure that you're saving a fixed amount regularly, without having to think about it. But how do you choose the right savings vehicle for your emergency fund? You'll want to consider factors like liquidity, interest rates, and fees when choosing where to keep your emergency fund. A high-yield savings account or a money market fund with a low minimum balance requirement and no fees might be a good option. For instance, a high-yield savings account with a 2% interest rate can earn you $20 per year in interest on a $1,000 balance. But what about the potential downsides of keeping too much cash? Keeping too much cash can be a problem because of inflation, which can erode the purchasing power of your money over time. Let's say you have $10,000 in your emergency fund, and inflation is running at 2% per year. After 1 year, your $10,000 will have the same purchasing power as $9,800. But here's the catch: what if you need to